Good morning, everyone. Today, we are going to cover another important topic, which is cost of capital. And herein, we are going to discuss about conceptual foundations related to cost of capital. In order to ensure that the student should understand this particular topic in a more comprehensive manner, it is required that the student should be equipped with the following aspects: concept and importance of finance for business, various sources of finance, that is, long term sources of finance and short term sources of finance, various components related to long term and short term sources of finance, significance of these sources of finance for business organizations, and advantages and various limitations associated to these sources of finance. This lecture tries to cover the following aspects related to cost of capital. Cost of capital, concept of it, aspects or factors determining cost of capital, significance of cost of capital for business organizations, classification of cost from decision making perspective, problems in determining cost of capital, finance, which is considered as a lifeblood for business organizations, is crucial for any sort of business organization. Finance is required by business for varied purposes, focusing upon long term and short term aspects. Without finance, a business cannot sustain for long. These long term and short term financial requirements can be fulfilled by various means, which includes issue of shares, issue of preference shares, issue of debentures, taking loan from bank or financial institutions, etc. However, companies are required to bear certain costs in order to arrange for these sources. This cost is known as cost of capital. Cost of capital is one of the prominent and fundamental concept of theory related to financial management. Cost of capital holds importance because of its applicability, which includes use of cost of capital in capital budgeting decisions, cost of capital refers to the minimum rate of return a firm must earn in order to satisfy the expectations of its investors so that they make their funds available to the firm. Cost of capital can also be considered as weighted average cost of capital of various sources of finance used by a firm. As has been mentioned earlier, that capital used by a firm may be arranged through various sources, which includes debt, preference capital, equity shares, retained earnings. The cost of capital of a firm or the minimum rate of return expected by the investors has a direct relation with the risk involved in the firm. In other words, higher the risk involved in a firm, higher is the cost of capital. Since cost of capital is the minimum expected rate of return of the investment made by the investors, or suppliers of funds of the firm. The expected rate of return depends upon the risk features of the firm, risk perception of the investors, and the host of various other factors. Various factors that are relevant for the determination of cost of capital of the firm includes: first, risk-free rate of return. Risk-free rate of return is the expected normal rate of return at zero risk level or risk-free or default-free securities. For example, investment in government securities, investment in banks, etc., are considered as risk-free rate of returns. Business risk is another major factor. Business risk is the firm's promise to pay interest and dividends to its investors of different securities. Financial risk, which is another major factor in determining cost of capital, is associated with mix of different sources of finance used in the capital structure of the company. In addition to these, there are various other considerations that also have an impact in determining cost of capital. Considering that there are various factors other than risk-free rate of return, business risk, and financial risk, investors generally add on a premium with reference to other factors. One of the prominent factors within other factors may be the liquidity or marketability of the investment. In this regard, higher the liquidity available with an investment, lower would be the premium expected or demanded by the investors, and vice versa. To put in mathematical formula, cost of capital is equal to sum total of risk-free rate of return, business risk, and financial risk. That is, K is equal to RO plus B plus F, wherein K represents cost of capital, RO represents risk-free rate of return, B represents business risk, and F represents premium for financial risk. As has already been said, that concept of cost of capital is very crucial in financial management as it plays a crucial role in capital budgeting decisions as well as capital structure decisions. In addition to these, cost of capital can also be used as a basis for evaluating the performance of the firm and management of various finance related aspects of business concerns. Thus, significance of cost of capital can be laid down as under: first, as an acceptance criteria in capital budgeting. Cost of capital holds significance for capital budgeting decisions as it ensures rational approach while making capital budgeting decision. Net present value method extensively uses cost of capital for decision making under capital budgeting. Cost of capital is also useful as a determinant of capital mix in capital structure decisions. Since finance is required by business organizations for varied purpose, for example, paying day-to-day expenses, purchase of long-term assets, etc., it is crucial for an organization to have a proper mix of debt and equity capital for meeting out financial requirements, so that objective of financial management, that is maximizing the value of the firm, keeping cost of capital at lowest, can be achieved. This is possible only by way of measuring cost of capital from various sources of finance so as to identify optimum capital mix or optimum capital structure of a business organization. Cost of capital also holds importance as a basis for evaluating the financial performance. The concept of cost of capital can also be used to evaluate the financial performance of top management. Financial performance of the top management can be assessed by comparing the actual profitability of the project with the projected overall cost of capital and the actual cost of capital of funds raised to finance the project. In this regard, the performance of top management is considered as satisfactory if the actual profitability of the project is more than the projected and the actual cost of capital. Another major significance of cost of capital is as a basis for taking other financial decisions. In this regard, cost of capital also plays a very crucial role in making various other financial decisions such as dividend payout ratio or determining the dividend policy of the company, capitalization of profits, right issue, and working capital decisions. In financial management, there are certain classifications with regard to cost that is being considered. And some of these classification includes first, historical cost and future cost. Historical costs are defined as book costs which are associated to past events that has already occurred. In contrast to this, future cost is the expected or estimated cost that may be incurred in future. For decision making under financial management, future costs holds more relevance than historical costs. However, historical costs acts as a guide for future cost as these costs are estimated on the basis of historical costs only. Another major classification in financial management with regard to cost is that of specific and composite cost. Specific cost refers to the cost incurred over a specific source of finance. On the other hand, composite cost refers to the combined or overall cost of various sources of finance utilized by the entity. In business organizations, since different sources of finance is being utilized for arranging funds, therefore, combined cost should be considered for decision making rather than specific costs. In this regard, if the entity has arranged finance through one source only, then specific cost of capital for the same can be considered for decision making. Another major classification of cost in financial management is of explicit cost and implicit cost. Explicit cost refers to the costs incurred for acquiring funds from external sources. These include costs related to issue of debentures, issue of preference shares, and issue of equity shares. In contrast to this, implicit cost refers to costs incurred for arranging funds from sources that exist within the company itself. These include sources like retained earnings. Implicit cost is also known as opportunity cost. Classification of cost on the basis of average cost and marginal cost is another major classification of cost in financial management. Average cost refers to the overall or combined cost of various sources of finance like debentures, preference shares, and equity shares. It is also termed as weighted average cost of capital. Marginal cost of capital, on the other hand, refers to the average cost of capital which has to be incurred by the firm for acquiring additional funds required by the firm. From the perspective of investment decisions, it is the marginal cost which holds relevance and should be taken into consideration by the organizations. Though cost of capital plays very crucial role in the decision making under financial management, still the biggest difficulty that arises is with regard to determination of cost of capital due to conceptual differences or issues and uncertainties with proposed investment and the pattern of financing. The major problems that is being faced in determining cost of capital includes first, conceptual controversies regarding the relationship between the cost of capital and the capital structure. Number of theories have been propounded by different authors establishing and explaining the relationship between capital structure, cost of capital, and value of the firm. The differing views of these theories has resulted in various conceptual difficulties. For example, according to net income approach, cost of capital and value of the firm has direct relationship with the mode and extent or level of financing. In contrast to this, according to net operating income approach, cost of capital and value of the firm does not have any kind of relationship with mode and extent of financing. Moreover, according to traditional approach, which acts as an intermediary approach, states relationship between cost of capital and value of the firm to certain extent of mode of financing. Similarly, approach also supports two extremes based on certain assumptions. Consideration to historical cost or future cost is another major problem in determination of cost of capital. Differences of opinion with regard to concept of cost is another major consideration that poses problem in the determination of cost of capital. There had been arguments in favor and in against as well with regard to usage of historical and future cost. In this regard, it is argued that historical costs are book costs and are irrelevant for decision making purpose. as these costs are related to past. Thus, future estimated costs are more relevant than historical cost for decision-making process. Similar type of arguments have also been given in favor of specific cost and composite cost as well as explicit cost and implicit cost and the marginal cost as well. Problem in computation of cost of equity is another major problem. While calculating cost of equity, expected rate of return by investors is a major determining factor. Expectation can't be quantified with reasonable accuracy since there are several factors that influence investors' valuation about the firm. Problem in computation of cost of retained earnings is another major problem in determining cost of capital. It is sometimes argued that retained earnings does not involve any cost as such, as it is the funds which remains with the firm itself. However, in reality, cost of retained earnings is the opportunity cost of dividends foregone by the shareholders. This is because of the reason that the portion reflecting retained earnings of the firm is that portion of profits which would otherwise have been distributed as dividends to the equity shareholders. Problem in assigning weights is another major consideration or determining factor while calculating cost of capital. While determining weighted average cost of capital, certain weights have to be assigned to specific costs available or associated to individual source of finance. The decision to choose book value or market value for the source of finance poses another major problem in determining cost of capital. Herein are the few references which have been utilized to prepare this lecture, and students can access these references in order to ensure much more comprehensive and better understanding about the topic cost of capital. Thank you. Stay safe, stay healthy.